Hello everyone, in this video today we're going to be going through the topic of asset retirement obligations, AROs, and then a very quick discussion about self-insurance. Okay, the main focus is AROs, but we do have this other topic of self-insurance to cover a little bit as well. Okay, so what is an asset retirement obligation? What is an ARO? It is a legal obligation associated with the retirement of a tangible long-lived asset. Okay, so some things that may result in an ARO are things such as, cost to close a mining facility, cost to dismantle and restore oil and gas drilling properties, and then cost to close a landfill. Okay, so they're basically things where, we're doing something such as, we're drilling for oil or gas, or we're doing a mining facility, something like that. Okay, and we have this sort of legal obligation to, basically restore land or do something of that nature at the end of the life of the asset. Okay, so companies must record AROs at the fair value of the cost to retire the long-lived asset. Okay, the fair value is equal to the present value of the estimated cost to settle legal obligation. Okay, so what happens with these AROs is that, again, we have this legal obligation to restore some sort of, like the land or on a mining facility, or dismantle, a drilling property, something like this. And so what happens is that we're going to have to pay out a certain amount to settle this asset retirement obligation when we have to actually settle the liability. Okay, and so what we'll do is that we'll determine that estimated cost in the future, and then we discount it back to the present. We determine the present value of the estimated cost to settle the legal obligation. That's what we recorded at initially. That's the fair value of the cost of the to retire the long-lived asset. Okay. Additionally, when recording the ARO, the company debits the long-lived asset associated with the ARO and credits the ARO for the fair value of the ARO. And then the cost of the ARO is capitalized into the asset account because it is a cost to repair the asset for its intended use. Okay, we must pay these costs out at the end of the useful life of the ARO, of the asset associated with the ARO. And so as a result, it's going to be included in the cost of the asset associated with the ARO. Okay, so that's AROs. Then we have self-insurance, just very quickly. Self-insurance is when a company does not purchase insurance from an insurance provider and instead assumes the risk associated with potential future liabilities. Okay, companies do not record a liability for self-insurance unless an event has taken place that exposes the company to liability. Okay, so again, self-insurance is just when a company says, well, if we end up having these claims, we're gonna have to pay them out ourselves. Okay, they're not actually taking out insurance or anything like that. It's just an assumption of risk by the company saying, if there's a problem, we're gonna cover it. And companies do not record any liabilities until an event happens that says, oh, okay, you might have to pay something out. Okay, so that's basically what you need to know for self-insurance. AROs, let's go through a quick problem here. Let's make sure we have everything showing. All right, perfect. Can move this down a little bit. Asset retirement obligation problem. XYZ company is in the business of mining coal and employs numerous machines that help the company retrieve coal from mines. On January 1st of 2012, the company began its mining operations by purchasing machinery that cost $5 million. The company elected to use straight-line depreciation for the machinery. Additionally, the company estimated it would use the machinery for the entire life of the mine, which is 10 years, and that the machine would have zero residual value. Okay? When XYZ is done using the mine, it will have to restore the land. The company estimates that the restoration will cost $750,000, and their normal borrowing rate is 10%. Okay, so now we need to prepare the entries for XYZ for the following dates: January 1 of 2012, December 31 of 2012, December 31 of 2013, and then December 31 of 2021. Okay, so basically we're doing the first 2 years of entries for this problem, and then we're just going to skip to the last year, because what's going to happen is that we'll see that after the first 2 year ends, so December 31 of 2012 and 2013, it's going to be the same set of journal entries with different numbers. So what we're going to do is, after we've done those two, we're just going to skip ahead to the final year, so that way we don't have to do every single year in between, because that's just repetitive and it's literally the same entries with a little bit of a different number each year. But once we understand the intuition, we can just skip to the end. Okay. Assume also that XYZ settled the ARO on December 31, 2021 for $740,000. Okay, so we're told that the machinery costs $5 million. So we know we're going to capitalize that cost into the cost of the machinery. But we see that we have $5,289,158. Okay, so what is going on there? Okay, well, first we have the cost of the machine, but then if we remember from the beginning, we have to actually capitalize the ARO into the long-lived asset. Okay, we debit the long-lived asset account associated with the ARO and credit the ARO for the fair value of the ARO. Okay, so we need to determine the fair value of the ARO. What's the fair value of the ARO? It is the present value of the asset retirement obligation. It tells us we're going to have to pay $750,000 in 10 years, okay, to actually restore the land. Okay, so that would be our future value. Our payment is 0 because we don't have any coupon payments each year. We're just making one lump sum payment after 10 years. Our N is 10 years. Our interest rate is 10%. It tells us right here, which means our present value is $289,158. Okay, so again, we're going to capitalize that $157 into the machinery account. So we have two things going in: the cost of the machine and then the value of the ARO, the fair value of the ARO. Okay, so that means we'll do $289,157 along with $5 million into the machinery. The cash, they actually pay out cash of $5 million for the machine, and then they have to record the asset retirement obligation at the fair value of the asset retirement obligation. Okay, so that's the first journal entry that we do. Okay, then we're going to flip to the next page. We just have 2 more pages here. The next page at the very top, let's just get both of these in the picture here. All right, perfect. So at the top here, we'll see we have an ARO amortization schedule. Okay, this is basically just saying here's the dates, and then here's the interest expense at 10%, okay? And then we have the carrying value of the asset retirement obligation. Why do we have interest expense? Well, we have a liability, right? Basically what happens, okay, is that you can see this is our initial carrying value, and then at the end of 2021, we have $750,000. Obviously, it's off by $1, okay, but that's the amount that we're actually going to have to pay out, right? So it should be $750,000. Basically, as of December 31, 2021. Basically, what we're doing with the asset retirement obligation is that we're first valuing it, we're first recording it at the fair value, the present value of the ARO. And then each year, we're going to grow the ARO. We're going to increase the value of the ARO, okay? Which means to do that, we have to record interest expense, okay? And basically, we're going to record interest expense each year, and that's going to increase the value, the carrying value of the asset retirement obligation. And we're going to keep increasing the asset retirement obligations value, the carrying value, until $750,000, until the last day, until we actually pay it off, okay? And once we pay it off, we want it to be the full amount that we said we're going to have to pay off, which is $750 in this case, okay? So the way that we do this is that we take the carrying value of the ARO, we multiply it by 10%, that gives us our interest expense, okay? That's how we calculate interest expense for our asset retirement obligation, okay? Then the other thing we're going to have to calculate each period is depreciation expense. So again, remember, we capitalized $5,289,157 into the machinery account, right? Okay. Then we were told that has a useful life of 10 years and a 0 residual value, and we're using straight line. So that means it would just be $5,289,157 divided by 10 years gives us $528,916 of depreciation expense every single year, okay? So the first year, December 31, 2012, that's our first end year entry. Depreciation expense, debit $528,916, accumulated depreciation credit $528,916. Again, the depreciation expense is coming from here. It's just basically the carrying value of the asset divided by 10 years. Because there's no residual value, we're doing straight line. Again, interest expense, we take the carrying value at the beginning of the year, we multiply by 10%. As we can see from our amortization table, it's $28,916. So interest expense, debit, $28,916, increase the value of the asset retirement obligation, $28,916. Again, the asset retirement obligation is a liability. So to increase it, we will credit it. Okay? So that's the end of the first year. Okay? Then we will have the end of the second year. Okay, the depreciation expense exactly the same, right? That's not going to change from year to year. What is going to change is the interest expense. Okay, so what we have to do is that we have to take our initial carrying value of $289,157, add the amount that was amortized last year, because again, we're increasing the value, right? If we looked at our journal entry, we would see that we're increasing the value of the asset retirement obligation, okay, by $28,916. That means that as of the beginning of 2013, the asset retirement obligation is $318,073. Okay, if we multiply that by 10% to record the 2013 interest expense, it's $31,807. Okay, and we have that same calculation here. It's just showing two parts. The first is the beginning balance at January 1 plus the interest expense recorded in 2012. Then that would give us, this is January 1 of 2012, then the interest expense from 2012. That would give us the carrying value as of January 1st of 2013, which again is this $318,000. Multiply that by 10%, $31,807 as our interest expense. So then, again, same entry for accumulated depreciation and depreciation expense. Then interest expense, $31,807. Asset retirement obligation, $31,807. Then we have our last journal entry to make, last year of journal entries to make, which is for 2021. Again, depreciation expense is the same. The interest expense is $68,182. Where are we getting that? Well, if we look at our amortization chart, we'll see the very last year is $68,182. Again, what we're doing every year is we're taking this carrying value, multiplying it by 10%. Then we take the interest expense, add to the carrying value to get the new carrying value. Again, multiply interest expense by 10%. Add the interest expense to the carrying value to get the new carrying value. We keep doing that over and over and over again. So for the last year, we would take $681,817 multiplied by 10%. That gives us $68,182 for interest expense. Okay? That means we record interest expense of $68,182, asset retirement obligation $68,182. And we record our depreciation expense journal entry as well. Okay, remember that after that last entry, our ARO is stated at $750,000 on the books. Then what happens is that we have to settle that obligation, okay, because it's the end of the period. It's the last date that we're using this mine, and so we have to restore the land, okay? So let's say that we're assuming that ARO settles the ARO on December 31 for $740,000. Okay, so they actually have to pay out cash of $740,000, okay? So what we're going to do is that we have to record gain or loss. Okay, so they remove the ARO at $750,000, right? Because that's the full value of the ARO they're getting rid of. They're removing the full value of the liability. Then they pay out cash of $740,000. Well, in this case, we have a gain, right? Because we pay less to record the value of the liability, right? We're only paying $740,000 to get rid of a liability that's worth $750,000. So we have a gain of $10,000. So we have gain on settlement of ARO. Also, we can also just think about it in terms of debits and credits, right? We have a deficit on the credit side, so it must be a gain in that sense. But yeah, so that's basically these problems, okay? You have to be able to record this initial entry, then record depreciation expense and interest expense each year. And then the very last entry is this entry where we're settling the ARO. We take off the ARO at the full value of it, which is always going to be the amount they tell you at the beginning of the problem, the full cost. The cash goes out at however much it tells you. Okay, and then you have to determine gain loss. Okay, if you pay more than the value of the ARO, that's a loss. If you pay less, as in this case, it's a gain. Okay, so that's the end of this video. I just mainly set up this chart just for demonstration purposes. You don't have to actually set that up yourself if you're just asked to do a few years. But if you are asked to do the entire problem, then you kind of do need to set that up just so that way you can make sure that you keep it clear. Okay, either that or you have to do the calculation separately each year. Okay, so that is the end of this video, and I hope that was helpful.